the basic concepts and principles of insurance. Let's talk for a minute about how old the ideas and concepts of insurance are. One of the most basic principles of insurance is that when people want to protect themselves, one of the ways to protect yourself from damage is to, in history, band together so that you had more people to gather that could protect themselves from bad things happening. And so way back in history, and many, many years ago, in ancient tablets, they talked about people banding together. One of the things that we think about when we talk about banding together, well, in the ancient world, is they do archaeological digs and so forth, they find that people built walls around their city. Because if the wall was built and it was strong, other people could not get to you that wanted to do damage to you as easily. And so then one night watchman could watch from the top of the wall and tell if there were bad things coming, small bands of people, armies, whatever, and to warn the people inside so that all of the people who were sleeping could wake up and be attentive to the dangers. And so when our forefathers came across America towards California, where many, many people, and so what did they do? They came in wagon trains. Well, when the wagon master said, here's where we're going to stop for tonight, what did they do? Well, they put all the wagons in a circle, because if there were bad things outside of that circle, then there could be tremendous firepower from inside that circle to defend themselves if they wanted to be shooting at the bad things that could do them harm outside that circle. Well, that's what we do to a certain extent. We band together and we form insurances. And what do? Well, a whole bunch of people put their money together in a great big pile so that if one person has a loss, some of that great big pile of money, the accumulation of premium from a whole bunch of people, can go to pay that. That is putting together, through history, people have learned that they need to do that. Well, one of the first persons to set up an insurance company in America was Benjamin Franklin. And he came out with insurance where he had people contribute, and then they would all band together to protect against fire. And so if you had one fire out of a whole bunch of homes in the community, then the people would all have contributed some premium, or maybe they would pay afterwards, and then they would all collect to reimburse the person or rebuild the house that was burnt. So that's the concept of insurance. Now, we have a whole lot of words and vocabulary that you need to know. We're going to go through a whole bunch of vocabulary and words that are important for you to understand in the insurance business. Words that you may know from past, or words that you now will begin to know with relation to insurance. So, what is the definition of insurance? Well, we have several definitions, but to start with, we want to know one of the definitions is indemnification or indemnity. And so what does the word indemnity mean? Well, indemnity means to secure against hurt, loss, or damage. Secure against it. So, how could we secure against it? Well, if we have a fire in our house, the insurance company pays us, and we have a contractor come in and pay the contractor to rebuild our house back to the way it's supposed to be. The principle of indemnity, protecting us from the loss that has happened, to make compensation for incurred hurt, loss, or damage. So with health insurance, if I'm driving my car and somebody hits me and I have to go to the hospital because I have a broken leg or a broken arm, then what happens is the insurance of the person who hit me and hit my car is going to pay the doctor bill because the law requires them to have insurance or in some way or have proof that they can pay financial responsibility. So if I have a loss, I get compensated, or if I do damage to somebody else, they get compensated. And if I choose, and I've got lots of money, I choose to put a bunch of money aside, then my money has to go to take care of them. So they would be paid. If I'm injured, then I get paid, whoever the injured party is. So we have what we refer to as tort law. And we're going to talk about that. Tort law is when somebody causes damage or causes harm to somebody else. And so we have the principle of indemnity. One of the things that we need to understand is that whenever somebody is damaged, insurance, if they have the right kind of coverage, they receive a reimbursement for loss. So if my house has a $5,000 loss to it, and my insurance company, after I have the deductible of $500 or $1,000 after they pay, if I have a $5,000 loss, the deductible is $1,000, for example, then my insurance company pays me the $4,000 to have my house rebuilt back to where it was. That's reimbursement. Another way of saying secure is to free from the danger of hurt, loss, or damage. Another way to say make compensation is to remunerate or reimburse an insured hurt, loss, or damage. So insurance is there to take care of us. Now, the principle of indemnity we need to talk about for a few minutes. Bringing someone back to where they were before the loss or payment for loss. So principle of indemnity is bringing somebody back to the same position they were before the loss. Another way of saying that is making them whole again. So if they make you whole again, you have a car accident, you have a hurt arm, and the doctor bill and so forth is a certain amount, and your car is damaged, the insurance company of somebody else who has the liability, or they pay, legal to do that, they pay for your car to be fixed back to the same position it was before with the same type of material and paint and all of that kind of stuff, so that your car now is made back like it was. That's the principle of indemnity, to make you whole again, not to take you to a better spot than you were before, but to bring you back to where you were. You can't make money on insurance. In other words, theoretically, you're not supposed to be able to make money on insurance. Well, there are times when the car that you are driving is damaged, and maybe they put a new fender on it, a new front parts and so forth, that are brand new. So now you have a car that has a brand new fender on it. Well, that fender by itself, and so then maybe somebody could paint it so that it looks enough to match that nobody noticed the difference. But it's not uncommon for a car to have faded enough, so then it really needs to be repainted. So even though they're putting on a new fender and they're bringing the fender and all of that stuff back to where it looks very nice, maybe the whole car needs to be painted so that it would be satisfactory. So we say, well, maybe that does bring you back to the same position or a little better, because now you have a car that looks new and shiny and all of that kind of stuff. However, it is not bringing you back to a new car. It's only bringing you back to the same position you were before the loss. So you have a car that looks good. There is a test question that talks about the principle of indemnity or the principle of insurance. The question maybe would say, what is one of the answers that would be the same or equivalent to the principle of insurance? You would check the box that says principle of indemnity, because that's what insurance does. Brings you back to the same position it was before the loss. Principle of indemnity. And so then insurance is a contract. Well, we have a contract. A contract can be quite simple. It can be very complicated. In years past, it used to be that we talked about a man is worth his word. If he said, I will do such and such, then that was a verbal contract. Now, verbal contracts can be as binding as written contracts. And some of them are more complicated than written contracts. And so when somebody stands up, as I did a few months ago, and married a wonderful lady because my spouse had passed away, her spouse had passed away, and so now we're together and taking care of each other. But when I said I do, when she said I do, that's a verbal contract. Woohoo! A verbal contract is sometimes more complicated than a written contract, as a marriage contract can be. Well, I'm excited about what has happened in my life, and that's all wonderful. Now, what about a written contract? Well, a contract of insurance is a written contract, and the reason that we say it's a written contract, because there's a whole bunch of details, and then it must be spelled out. It tells what the insurance company is supposed to do. It tells what Mr. Client is supposed to do in very detailed explanation. That is a contract. And so we have contracts for insurance in many different areas. It can cover property. It can cover casualty. It can cover life insurance. It can cover health insurance. It can cover annuity insurance. These are types of insurance that are connected to objects or people. So a contract is something that is connected and insuring either people or property. And insurance protection against a financial loss of some kind or other. So these are things that we say you can have a value of, and a value can be established. In a court of law, you might have a value established for pain and suffering, etc. Well, it may not be pain and suffering. It may be very specific. The bill that the doctor charged or the hospital charged, or the amount very specifically to fix the car that's damaged, or to pay for the cow you hit that was out in the reservation where cows can roam free, and if you hit a cow, you're responsible to pay for that cow. So now what do we have? Well, we have loss of property. That would be loss of your home. An animal that was a prize. You could have human personal loss or human personnel loss. So if you have human loss, it can be divided into personal loss or personnel loss. Well, personal loss would be if you lose a family member or a family member gets sick or whatever that way. Personnel loss is to a business if one of their workers gets injured or hurt and it costs the business because of downtime and all of that kind of stuff. That would be personnel loss. And then we have losses associated with legal liability. Well, legal liability is when we have damages that can happen that we cause and we have to pay for that happens to somebody else. And so then losses associated with legal liability. Loss in general means the reduction in value. So if it's reducing the value of something, then all of a sudden that's a loss. Or it could be pain and suffering. And so then maybe you can't work. That is loss of value. Pain and suffering, we say, hurts somebody. And so then that would be a loss that would occur. Many times, property and casualty is required to be purchased by law. Well, you don't have to purchase auto insurance as long as you provide proof that you can pay. But if you can't provide proof that you can pay, the law says you have to pay it. With homeowners, you don't have to buy a homeowner's policy. But if you have a loan, which most of us do on our homes, then we have to provide insurance because the loan company won't give us a loan. And if we have a loan and we don't buy insurance, they'll buy it for us and charge us big time for that loss. So in this area of insurance that you're studying for, wanting to become licensed, most of the time what you sell, the law requires people to buy it. Isn't that great? If the law requires people to buy what you're selling, man, all you have to do is smile and say, here it is. Can I help you? Woohoo! If indeed you can get in front of enough people and your company is a decent company, you're able to sell what we're wanting you to learn how to sell and so forth. That is the principle of indemnity, and people will buy because they're required to.